What's going on, everybody? Jeff here. Welcome back to the channel. All right, guys, this could be a very big turning point for the market. We had a massive daily rejection as well as a weekly rejection. The S&P closed the week red for the first time since the week of July 11th. We had 4 solid green weeks, big move to the upside, a lot of heavily bearish sentiment that was tacked on at the end of June after the high inflation just kind of got shredded by market makers. Now we are at a bit of a turning point, and I want to talk about it because the next few weeks are going to be very crucial. So let's get right into it. First off, this is the weekly chart for the S&P 500. Take a look at the SPY. As you can see right here, this is the first red candle we've had since going back to the week of July 11th. Now this candle is also known as a shooting star. Now a shooting star is a bearish formation. That is a long upper shadow or wick, little to no lower wick, and a small real body near the low of the day. And as you can see, this is just over a larger time frame. Anytime you see these candlesticks over a larger time frame, their influence is a little bit greater. Now, the last time we had a candle similar to this is going back to the end of March. And I've talked about the time frame from the end of March rally that we had, and I'm going to talk a little bit about it later on in this video. But as you can see, we moved down 100 points from that level that we hit at the end of March. Now, while I do think that 100 points is a bit of a stretch from the 420 level we are at right now, especially because there are some positive catalysts over the next 6 to 12 months, which I will talk about as well. The market is due for a little bit of a pullback. We've had really low volume, and hedge fund managers are going to start coming back to the work, and they have bills to pay. We are also coming up to the month of September. Now, this is a chart right here that just goes over the average monthly returns for the S&P 500. And while September is the worst, August is also the second worst. And we still do have some time in August. But as you can see, there are some green months of August that clearly occur just because of look at the past few weeks that we've had. So this doesn't always play out, but it's good to keep in the back of your mind. Now, you want to take a look at something else is the put to call ratio. So I've always been one to want to follow some of the flow as it can really lead to price action. However, when one side gets to be overly crowded, it's very common for market makers to just shred those positions. That's how they make those money, especially when it's retail. They can clearly tell the difference between retail and institutional. Well, sentiment began to get really neutral. There's a lot of talk, and I'm sure you might even believe this or just see this all over the internet, that people are saying, listen, the bottom's in. The bottom was 360. We're going to move to the upside. The market already corrected. The NASDAQ is out of that bear market territory, as the headlines are showing. And sentiment got to be a little bit more neutral, as you can see over the next few on the 19th, and obviously over the next few expirations. But as you can clearly see, leading into a little bit longer of a time frame, the sentiment gets to be a little bit more bearish. And then in the immediate term, we've moved away from that extreme fear, which, as you know, when there's extreme fear, like I just stated, that's when, the bulls try to, pile in and really shake out some of the shorts, as well as market makers ripping. But now we're at a little bit of a neutral stance. So it's a good time to say, listen, if you've been long for a little bit while and you're green on some of the positions that that you've picked up over the past month or so, it might be time to scale some of those back. However, like I said, we are at a bit of a turning point. And when you look at the S&P 500 on the daily chart, okay, there was a lot of indecision occurring over the past few days shown by these candlesticks. Now, here's another thing I will talk about that was a massive rejection this week is take a look at this chart. Let me zoom in just a little bit more for you. This shows the 50 or the 20, the 50, and the 200-day moving average. And as you can see clearly just a few days ago, okay, on the 16th, we rejected off that 200-day moving average, which is a very, very big and well-respected indicator, especially inside the indices. So keep that in mind, okay, as a little bit of a bearish sentiment as well. Another thing is crypto. Now, crypto was really the leading candidate, okay, an indicator over the weekends. Over the past few months, the correlation started to kind of separate a little bit, but there still is a big correlation here. And especially when Bitcoin does pull over the weekend, you saw the S&P and the futures open up red going forward. Now Bitcoin has pulled back from where it was, and I talk about crypto as a whole, but because Bitcoin is such heavily weighted, I really just focus on that. And Bitcoin has pulled back clearly from that $25,000 level of rejection. So keep that in mind over the next coming week. Now, the other thing I do want to point out is this, and this kind of makes things a little on the interesting side, especially when you're looking for some bearish sentiment. So I've mentioned before Apple. We're inside this bear market. SPY was trading at 420, down from that high of 480, and here you have Apple, which at the time was at about 172, really close, less than 10% away from this all-time highs of 183, and it hit that 176 level. Now, this is the same rejection that we had talked about at the end of March, around that 176 to close to 180 area. I'll use that range, okay, as a reference. But where we were trading for the entire market back in March was around that 456 to 460 area, and we are only at the 428 to 432 area. Okay, so if the market continues to get weighted and change just like it did at the end of March, seeing that sub 400 is very clear. And if you look at the next level of support, because we do have that gap all the way down to that 412 area after obviously lower than expected inflation came out and we ripped to the upside, is that next moving average of the 20-day simple moving average down about that 415 area, which would be in the gap. So I would probably say that 412 area, you could look for more bulls to step in, and that's if we open up red on Monday. Okay, so keep that in mind. Last thing I do want to talk about, which is actually more of a pretty much a bullish sentiment, especially over the medium term. So this is what investors are pricing in when it comes to interest rates. And when you talk about interest rates, you kind of really have to leave some of your bias, aside from this. In one sense, you think to yourself, listen, inflation needs to come down. And the only way to, a lot of times they talk about, inflation, especially such high inflation, is, the Fed fund rate actually has to be higher than that level. So if inflation, let's say, gets down to, 8% on average, that the federal fund rate needs to be higher than 8%. And there's a lot of room for argument why that can't happen. One is going to be, we're raising rates into a slowing economy that would guarantee us, put us into a recession, if not a depression. Okay, you also have the insane amount of money that the Federal, Reserve is in debt. Okay, our massive debt that we pay interest on, and therefore we're only, getting so much tax dollars that to waste more money on interest. There's a whole big argument to that, and investors have priced in saying, listen, inflation is going to come down, and it could be for one, their just a wild way of rating inflation, or their easily ability to be able to manipulate inflation. Okay, you can clearly see that price at the pump has continuing to come down. Energy sector, being negative last month is what really the reason why inflation was down. But where you look at where the target rate is right now, it's about, let's say, 2.5% on the high side. Right now, investors have shifted a little bit away from that 75 basis point hike, as you can see here in September, and have really geared towards that 50 basis point hike. But when you go all the way out to that June timeframe, and I always talk about how the market is anywhere between, some people say 6 to 9 months, I like to say 8 to 12 months forward looking. We're still sitting at most investors are pricing in, listen, it's going to be at 3.5%. And when you go out to July, actually they're starting to even factor in a little bit greater. Listen, the Fed is going to have to decrease rates, and they will have to decrease rates. Okay, eventually, the economy is going to get to a point to where it is slowing, and in order to kickstart the economy, you've got to lower rates so people are more incentivized to be able to borrow. Businesses are going to borrow money, pump that money, as it's basically free money. When the interest rates are very low, it's pretty much free money. So it is going to happen. However, I think the time frame might be a little bit off, but that is a bullish sign, for the let's say, the 8 to 12 months time frame. So keep that in mind. But for the shorter time frame, just know we bounce off that 200-day moving average. When you look at the weekly chart, we almost rejected off the 50-day or the 50-week moving average. As you can see here, this is a massive shooting star. So my targets, if we do continue to open up red, you see Bitcoin pull back a little bit. That $20,000 level is going to be, a big psychological level. Expect bulls to step in. If we open up red on Monday, that next target will be potentially to fill that gap down to that 412 level. So guys, that is it for this video. See you in the next one.